Good morning and a very warm welcome to the members who have joined for this excellent session on VCM on the ESOP valuations, models and issues. As usual, we are running this series on all Sundays and today is the 8th episode. And we have with us today the chairman of the Valuation Standard Board, CNL Bhandari, Vice Chairman of the Valuation Standard Board, MP Vijay Kumar, and our guest speaker for today, TV Bala Subramanian, who is a independent professional registered valuer and has been helping the institute in all these knowledge dissemination series. And along with this panel, I have the Secretary to the Valuation Standard Board, CS Sarika Singhal. Welcome once again. And to set the context, the ESOPs have been in existence as part of the compensation structure, not only to address the competitive scenario, but to address the high attrition rates, and employers have been tweaking them to act as drivers of employee engagement. While US was the epicenter of this concept of so-called shared capitalism, with the pay coupled with the equity stake or a cash payout based on equity stake. Well, lately we are also seeing this concept coming up in India, and we see the startup ecosystem, many unicorns coming up, and this has more than a fad now that ESOPs are into play. Along with the ESOPs, another concept, the stock appreciation right, has also come into play with the regulatory capping on the issuance of ESOPs. Now, talk about the regulatory construct. We have the Companies Act and the Companies Share Capital Debenture rules, which provide for the employee stock option and the sweat equity shares by issuance and allotment of shares, either for cash on fair market value of shares or for cash on a concessional basis or on a cashless basis. And there are many enactments like the Contract Act, trust-related legislation, which have impact on the ESOPs and the income tax and foreign exchange laws and rules and regulations. Further, the SEBI SBEB regulations also apply to the listed and unlisted entities as far as these ESOPs and SARs are concerned. Now, to talk about the session for today, the valuation remains the core issues, whether in the ESOP or in context of valuing the SARs in ESOP companies, or when analyzing the repurchase obligation and how it affects the valuation, since there are lock-in provisions for sweat equity. Equally important is how to explore ESOP contribution expenses in the valuation exercise. The session today, I think, is going to demystify many of these issues around the accounting, taxation, and related purposes and their valuation methods. So with these brief background, may I now request CNL Bhandari, Chairman of the Board, to carry forward the proceedings of the session. Over to you, CNL Bhandari.
Thank you, Rakesh ji. A very warm welcome and a very good morning to all our viewers once again, and welcome to this series on Sundays with Valuation Experts. And Rakesh ji, thank you so much for setting the context perfectly right with your deliberation. Of course, I welcome MPV, the Vice Chairman of the board, and TV Bala Subramaniam. Bala, do they call you Bala or do they call you TV? I mean, sometimes, I'm sorry, I can't hear you.
Most of them call me Balu. Some people call me TVD.
Okay.
From
so
past.
If you don't mind, I'll call you Balu as well, because I think this is the second engagement that I'm having with you. And the first one was fantastic. I learned a lot around minority. And today, I think I'm looking forward to learn a lot around the ESOP valuations. And I think, once again, this is a wonderful topic that Sarika has picked up. ESOP valuation is very, very interesting. I think Rakeshji spoke about wealth creation. I think if you read Economic Times today, besides COVID, I think you only see wealth creation done by a couple of unicorns, and they are not couple now. There are almost 24 unicorns coming up. And I could never imagine an Indian equity market gearing up and being ready to loss-making organizations and valuing them at 60,000 crores and stuff like that. It is unheard of. And I think maybe, I don't know, it's time that we are moving into that maturity curve. And I'm sure all of these organizations, or maybe most of them, would have ESOPs as a structure to engage with their employees. And I'm really fascinated to understand how people would have created wealth working for these set of organizations, and how quickly they work around it, and how quickly they scale up with some really good minds together. So I think if you have to have talent, if you want to retain them, ESOPs definitely is one way to look at it. Sometimes people say that ESOPs is also expensive from that perspective. So, right or wrong, but I think it is definitely an instrument which keeps people engaged. And I think all our valuers must understand how to value ESOPs, because this is a very, very interesting subject. Also, I would definitely engage with you, Balu, to understand voting and non-voting shares. Typically, these are elements that they use abroad, and maybe some valuation aspects of that, if MPV would cover. So, MPV, to you, as usual, let's try and hit this very quickly.
Sure, Anil. Thank you, Anil. So, Balu, thanks for joining us again. So, as far as the stock option, today's session is concerned, I'd like to focus essentially on valuation of stock options, including stock appreciation rights. But maybe initial few minutes, it will be helpful if you could just articulate in simple words about what the stock option plan is all about and some of the key terms, because those terms will be very important when we discuss the valuation in detail.
Sure. Thank you. And it's my pleasure to be again here sharing whatever little I can. Each of these is enriching to me as much as what I am able to contribute. I'm sure, I think I'm picking up more from all the questions which come, and in that process, I am also learning surely on this. Just to give a very, very simple explanation of ESOP, is basically it's a scheme by which you are rewarding the employees or consultants in some cases also with equity as a remuneration, so that what happens is the company is able to conserve cash. The company is not spending money on cash. However, there is wealth which is coming to them depending on how well the company does. Of course, the ESOP has value only if the company does well. So that is one critical thing which needs to be considered. And the biggest advantage for the company is not having to shell out money in terms of this cash outflow is limited. Even if ESOP costs are absorbed into the accounts, it's a non-cash expenditure that way, really speaking. Of course, there are economic theories which, like Anilji was mentioning, it's in fact very costly because it leads to some dilution, obviously, because there is some equity which is going out. There is dilution. That is the economic part of it. But by and large, from a cash perspective, it significantly helps companies, and especially companies which are in the early stages. This becomes a very, very important tool for them to be able to compensate for those who have come in and worked with the company to build it without having to shell out that much of cash upfront. And early stage companies would also have difficulty in raising that as capital and spending it. So this way, it is a significantly useful tool. The words used are employee stock option plan, ESOP. So it's a stock which is an option for the employee to take. So there is an option for the employee to either take the stocks or just let it lapse. He need not take it. So that is exactly why the valuation is going to be slightly different. If it is a sweat equity and it is given immediately as shares, then the valuation is only valuation of shares. There is nothing else which is coming, or the equivalent asset which he is giving is valued. In ESOP, the crux is it's an option. Like you have a futures option, here there is an option which is being given to the employee. So the employee has an option to either exercise it or not exercise it. So that is why additionally, the option needs to be valued, which is unique compared to the regular stock valuations which we do. The unique nature comes out because this is valuing an option. So that is the crux of it. SAR also is similar in certain respects. It has some dissimilarities. We will see that in due course as we go into it. Coming to the key terms which are used in option valuation, I would like to just focus on the 6 elements which are also critical for the valuation of stock options, which would be a good starting point probably to go in. These 6 items are basically, first is what is known as the stock price. This is very simple. It is the price at which the stock is currently trading. Let's suppose, for example, if it is a listed stock, it could be the trading value. If it is unlisted, the shares will have to be first valued to arrive at the value of share at this point of time, at the point of grant or whatever. Second term, which is important in evaluation here, is the strike price or exercise price. So what is the strike price or exercise price? Let's assume today's market value of the share is determined at 100 rupees. It's a face value of 10 rupees. Today, market value is determined at 100 rupees. The companies could give an option to the employees to buy this or get this option over a period at a particular price, which could be 100 or it could be lower, it could be higher. That's a price which can be fixed because that is how they incentivize. So they say, okay, you can get it for 50 bucks. The next 3 years, you can get it at 50 bucks anytime of your choice. Whereas today's market value itself is 100 rupees. Let's say, for example, that is it. So this 50 bucks, which is what he has to pay to get that option, is called the exercise price. That is also important because that affects the value of the option significantly. And normally this is part of the structuring of the ESOP, which is there. The next issue which needs to be understood is the time for which the option is open. This is made up of 2 things here. So we will look at the 2 terminologies which are used. The first one is called the vesting. Vesting is the period over which the employee is expected to be giving his performance for which he is being given this option. So the vesting could be a simple vesting condition of just a lapse of years. Say, for example, if you stay with the company for 2 years, you will get this option. So here the vesting condition is only simple time, 2 years time. It could be even certain performance conditions which can be there, that in 2 years, your PAT becomes 10 crores. Yours meaning the company's PAT becomes 10 crores. So that could be the thing. It could be some more granular methods also which can be there. Or the market price of the share goes up from the present 100 to say 150 or 200. So these kind of various performance conditions could be there, and that period over which it is to be done, that performance is to be achieved, is called the vesting period. So vesting period is the period in which it is presumed that the consideration from the employee is coming to the company or being given this option. The second part of the time period is the exercise period. That is after vesting, how long he has to choose whether he wants to take the option or not. Meaning, he has a certain time period within which he has to pay that exercise money and take the shares. Otherwise, it lapses. He doesn't have a choice beyond that. So that is called as exercise period, which happens after the vesting. So the vesting period, exercise period, 2 things together make up the total time. So the total time is another aspect which has an impact on the ESOP valuation, because the longer the period, the more the value of the option is, which we will see as we look at further. The next issue is the volatility. The volatility is one of the critical things and probably the most difficult one amongst all these parameters required for option valuation to determine. Volatility is the expected movement of the stock prices up or down over the period. So it is the estimated move of the stock price. So to just give an example, if we have a share currently at market price of 100, now typically the market makes about 15%, 16% a year on an average. So let's assume this script is also expected to do 115 in, let's say, 1 year's time. So that aspect is also very critical in determining the value of the option. So how much will it be by the 2 years time I have for vesting and maybe another 5 years for exercise? What can this value become? So here the volatility is higher for high performance companies. It could be lower for very, very stable and basic companies. So that is how it could vary. So that is something which needs to be considered. The other two aspects which have an impact is any dividends paid out during this period. So obviously, to that extent, the option holder does not get any dividends, whereas the equity holders will get a dividend. So to that extent, there is some reduction. Though theoretically, this is a component. In the Indian context, typically the dividends are only a couple of percentage of the market prices, typically. So overall, generally, you find that this does not have a huge implication. Indian market does not have many stocks which are dividend-driven valuations. Valuations are driven more by capital appreciation expectations than dividend-driven expectations. So very little impact. Normally, it has. Normally, of course, there could always be exceptions, but that is one of the factors which needs to be considered. And the last one is the risk-free interest rate, which also has an impact because whatever increase is coming, part of it is because of just risk-free interest, which you anyway would have got by putting it in gilt-edged securities. So this also has an impact on the valuation. So there are the 6 key parameters which are required to do an option valuation. And like I said, when it comes to the time, it is further divided into the vesting period and the exercise period. These are very critical terms which we need to understand for ESOP valuation. Other aspects,
very helpful, Balu. In fact, those 6 elements which constitutes the inputs for the valuation of a stock option. Taking from there, see, I'm sure you are having engagements of valuation for listed companies where market conditions are applicable in the valuation. And there are very large number of unlisted companies also where we come across stock options where they are not affected by market conditions, but they're affected largely by performance conditions, which you articulated so well in terms of either time-based performance or in terms of quantum of production or revenue or profits, whatever be the metrics. So typically a valuation engagement, what would be the number of valuation engagements in a year with a company, and what is the frequency with which you would engage for a valuation?
Okay, when it comes to ESOP valuation, first let me give the broad picture of when all valuation is required in ESOP, which will touch upon this also, so that it gives the clarity of the requirement. The first time when a valuation is required is at the point of grant. So when the ESOP, when an option is being granted, that is the first time when valuation is required for an ESOP. So typically, if a company has multiple of grant dates in the same year, theoretically there would be multiple valuation requirements. Now let me also the practical side to it. If the expectation is that the prices do not significantly vary, for example, if it was a Zomato, then there are 4 option grants in a year, there could be 4 valuation reports. Maybe if it was, say, something like Tata Motors, maybe for all the 4, they may use a single valuation because they don't expect the values of prices to change significantly in that period, right? So this is the first thing. So theoretically, the requirement is every grant date there has to be a valuation. This is the first thing, and this is required for the purpose of accounting under the accounting standards. Even under the AS, there is a guidance note which recommends that accounting be done on the basis of option valuation. It also gives an option for a simpler accounting mechanism as a second option, which is their alternate method under Indian GAAP alone, which also will require share valuation to be done at that point of time.
So Balu, sorry to interject, but just wanted to have one clarification which you spoke about. Is it not, you're saying it's not mandatory that you need to keep valuing it, or is it mandatory? Who takes a call of the value say for example, Tata Motors and Zomato, who takes this call that it should be could be every grant, or it may not be required to be every grant?
Theoretical requirement is every grant will have to be done. So long as the company is able to determine and the auditors are also able to appreciate that the estimates are reasonably fine for, say, 2 grant dates which are reasonably within each other's time period, they could take a view that a single valuation would be acceptable. It's basically going back to the accounting standards
Sure.
and estimates
Okay.
and whether it is reasonable.
So, Balu, continuing from what Anil mentioned, what is the regulatory requirements for valuation? So, be it the Companies Act or SEBI or any other legislation. So, when it comes to stock valuations, what is the regulatory requirements?
Yeah. So, like I said, the first one is when the grant is made.
So, Balu, I think he has a network issue.
And Companies Act says that any
Yeah, he's back. He's back.
Balu,
we
had a network issue. Can you repeat right from the beginning of the answer?
Yeah. So the first one is, as I said, evaluation for accounting at the time of grant. Am I audible?
Okay. Yeah. Yes.
So
Yes, sir.
that, in my opinion, because it is accounting standards are notified under the Companies Act, and the Companies Act says that valuations are to be done by a registered valuer, it's a better interpretation to say that the valuation for accounting should be done by a registered valuer. Of course, there are people who take a different interpretation, and because it's under the accounting standards, they take a view that this is can be done by a chartered accountant. But my own personal view seems to be that it's better to get it done by a registered valuer. This is one area probably where some clarity will emerge. It's purely an interpretation issue. This is the first level where valuation is required. The second time when valuation is required is under Income Tax Act. Now, under Income Tax Act, valuation is required for the purpose of determining the taxability of this in the hands of the employee. Now, in the case of ESOP, it is taxed as a perquisite. In the case of SAR, if it is cash settled, it is treated as salary. If it is equity settled, it is again treated as perquisite. So, for this perquisite valuation, the income tax requirement is the valuation must be done by a merchant banker. It does not accept valuation by anybody else. It has to be done by a merchant banker. And this valuation is triggered at the point of exercise. Again, in a large company, what could happen is exercise could be happening in many dates. So theoretically, the law says on every date of exercise there should be a valuation. It is practical that mostly they try and take one valuation for a set of exercise dates, because they would be able to reasonably justify that it is not materially significant between those dates. And generally, the tax department also, if it is not going to be materially significant, they don't make an issue of it, or they have not made an issue of it. Though theoretically, it says it has to be on each exercise date. So that is how the law is presently.
Okay.
In addition to this, there is a valuation requirement which may come up at the end of each accounting period under 2 circumstances. Generally, an ESOP need not be valued after the grant date. It need not be again valued. But under 2 circumstances, it comes up. First one is where there is a ESOP condition, performance condition, which expects a change in the value itself. For example, wherever based on certain conditions, the exercise price itself will change based on the performance condition. For example, if the scheme says that within 2 years, you must achieve a PAT of 10 crores. If you achieve a PAT of 10 crores, the exercise price will be 25. If you achieve a PAT of 8 crores only, the exercise price will be 35. Then what happens is there is a performance criteria which is linked to the pricing. So there is a need to revalue it at the period end. So this is a possibility which can come. The second is where it is a equity settled SAR. We will be seeing more about SAR and
Balu, just to hold you on that one. So if I've understood you correctly, if I were an unlisted company, at the time of grant of the options, there is lack of clarity whether it's a legal requirement to have a registered valuer to do a valuation, or the company could themselves do a valuation. And in practice, we are seeing a mixed position. Similarly, at end of each accounting period, since some of the vesting conditions or excise conditions are linked to performance, the assumptions would change, and consequently you would remeasure. So that remeasurement can again either be company's own valuation based on a template acceptable to an auditor, or you could go to a registered valuer. So there is no legal requirement per se to engage a registered valuer for that year-end valuations. For example, if you look at our revised Schedule 3, 24th March 21, when you are looking at revaluation of fixed assets, intangible, MCA is now telling that you require the seal of a registered valuer. So we don't have any such requirement for year-end valuations. Is that understanding clear, Balu?
No. For both the grant time valuation and year-end valuation, it's an interpretation. There is two different interpretations which are there. One interpretation is yes, it is to be done by a registered valuer because it is coming under Companies Act and the standards are notified under the Companies Act. The other interpretation is it is only the standards which are notified. What is to be done under the standards is something different. So it can be done by anyone. So both interpretations are there. There is a gray area there. Yeah.
Okay.
For both grant time as well as year end.
Fundamentally, if the grant required registered valuer, I'm saying the intent for year ending should also ideally stick to that MPV. Am I right, Balu?
Logically, yes. Anil, logically, yes. Logically, yes.
Okay.
Now, Balu, going one step ahead. Say, we are seeing in the case of unlisted companies in particular, stock appreciation rights to be fairly popular because there could be many unlisted companies who may not like to eventually get listed or wherein people can't encash it in the market. So those cases, the company itself might be generating so much cash that they may like to discharge it in cash, and the principal shareholders might like to retain the shareholding. So if it were a SAR's valuation, how is it different from the stock options valuation? You gave 6 elements for stock option valuation. Is it the same 6 elements or there is something additional or to be deleted?
Okay. So now in SAR, which is basically stock appreciation rights. So the basic difference between an ESOP and a SAR is in an ESOP, the employee is promised a certain number of equity shares as an option, right? He can get it by paying a certain price. In an SAR, basically there are the fundamental thing which is being presented to the employee is what's today's price is 100. Now, whatever this price becomes, that minus this, the difference we will give it to you. So essentially, this is what the SAR is put as to the employee by the company. Now, let's assume in 2 years it's going to become 300. So essentially, the company is saying 300 minus 100, 200 we will give you. Now, how it is to be given? There are again 2 methods in which it can be given. One is cash, simple, 200 company will pay cash, or they will give 200 equivalent of equity. So it's called as equity settled SAR and cash settled SAR. Now, in both these cases, there is a need for valuing the SAR at each period end. Again, the elements used are the same 6 elements. there are two ways of valuing SAR. The simplistic or intrinsic value method of valuing SAR is, okay, at the end of the second year, my price has become from 100 to 150. So 150 minus 150 rupees I charge to expenditure. This is a simplistic method. Whereas, if you really look at it, what is being promised is that what will happen at the end of 3 years will be paid to them, right? So, based on the current scenario, you need to evaluate what is the price likely to be at the end of 3 years, again using option method, and then work out the difference. So this will require valuation to be done at every period end. SAR requires valuation to be done at every period end. And if it is equity settled itself, surely it has to be done because it has to be settled in equity, not even in cash. So the simplistic method is used by those who are following ICAI, and where the values are not significant, those companies are using the simplistic method of accounting.
So again, my question may be slightly off the grid, but what happens when you do for a listed entity, what happens when you do a quarterly limited review, maybe MPV or Balu?
We have to value, Anil.
Same.
So that means every quarter you would have to get it valued, or you don't have a choice, right?
Yeah, instead of doing annually, you'll have to do it quarterly. And unlike many other things which have to be done, even the fair valuation of financial instruments and all that, a stock option valuation might be a faster exercise. That way.
So are you telling me that all these companies actually go through this valuation exercise on a quarter-on-quarter basis?
Yeah, they are doing it.
Yes, I think, maybe we can give a
they do it, Anil. Only thing is what we do is we have our own modeling tool which we have where you have to just validate the inputs every quarter. So there's no legal requirement as we interpret that you have to get it from a external valuer. So that model itself throws up a number and you use it for the purpose of accounting. Both the audit committee and the auditors, both of them validate those numbers. So that's how we do it.
There's a lot of work for valuation experts and registered valuers if this were to be valued externally, right? But that also caused a lot of pain to keep getting it valued, right? I mean, I'm saying it works on both the sides. So anyway, that's a little off the grid.
Yeah, I would personally believe getting it externally valued is a better one.
Yeah.
Rather than we using standardized models over time, because my experience, Anil, is most of us have started building a lot of performance-based conditions in the stock option plans. So what happens is when you have so many performance conditions, it's good to have an independent person evaluating it versus the organization itself determining the estimation. What happens is, to borrow Balu's example, 10 crore profit. So we assume that 10 crore profit will achieve in the 10th year, in the third year. So that's an assumption I'm making. But if an independent valuer does, it sort of reduces a little bit of my responsibility liability.
Sure, of course. But fundamentally, this valuation could have ups and downs, right?
Yes.
Right.
So it does have a quarterly impact, actually. It does have a quarter impact.
Okay. Yeah, back to you, Balu. Sorry. I thought I'll just...
Just to touch upon what we said, it's basically like an estimate like you do for actuarial valuation of so many companies do only annually, though they have quarterly.
Balu, I don't know. Your voice is slightly distant, sounding distant to me. So maybe if you would...
Is it
yeah. Yeah, it's much better. Maybe I don't know if your volume on your computer is, you may just want to...
No, I'm on this thing. Maybe what I can do is I will switch on to my computer speakers.
Yeah.
Whatever works. It's slightly distant, yeah.
Yeah, now is it better?
Yeah, much better. Absolutely.
Now it's far better, actually.
So I'm using the computers.
Okay, great. Now it's far better, actually. So Balu, let's get to valuation now. So as far as the stock options are concerned, just like you gave a detailed explanation for the first question on the ESOP valuation, can you walk us through in very simple terms? There are many youngsters also listening to you now. Stock option valuation. how does that whole modeling work? So little bit of detail, and I'll try my best not to interrupt you in between.
Absolutely. Absolutely. So I basically started with saying that we discussed about when valuation is required and all. Let me take a simple example of a ESOP valuation. Now, in the ESOP valuation, the basic steps are like this. First and foremost, we need to determine whether it's a listed company or an unlisted company. Now, if it's a listed company, the current market price of the share is known. It's just readily available information compared to an unlisted company. In the case of an unlisted company, first and foremost, the shares have to be valued as on the grant date, because one of the 6 components which are required is the share price, current market price. So which will have to be the first step. Now, after having determined that step, then the next step is to determine the various other input requirements which are to go in. Now, each of these, let's look at. The exercise price is something which is generally...
Balu, sorry to interrupt. I would suggest that this piece, you go a little more slowly, because many participants have given us feedback over time that they would like to learn this stock option valuation in detail. So this piece, first part, determining value of share, perfect. The second step, how do we collect the... please go ahead.
So second step is to pick up all the other 5-6 variables which have to go in for the valuation. So the next element which is required for valuation is the exercise price which has to be applied, right? So the exercise price which has to be applied is driven by the ESOP scheme. Normally, the exercise price is clearly given in the ESOP scheme itself, except in some cases where it could happen is that the exercise price itself will be conditional on certain performance criteria. So now then we will have to determine the performance criteria based on which it is taken. So that is one of the judgments which will have to come. For example, if it is based on a performance criteria, if the company's profitability is like this or like this, the exercise price will be 25 or 35. Then what happens is the first thing is to apply judgment as to what is going to be the profitability they are expecting to achieve. And that all this will have to be also documented in the valuation report as to why and how it has been taken. So the second element is the exercise price. The third element is the risk-free rate of return. Why is this risk-free rate of return important? Like I said, this money, even if it was just kept in gilt edge, there are certain returns, it's a minimum return it will get anyway. So we need to eliminate that factor to determine the true growth which will come from the stock price improvement. So to determine that, this risk-free rate is a critical component in the valuation. Now here, to determine how the risk-free rate should be chosen, the data is available from FIMDA. There is a zero yield coupon curve which is available, from which we can take the rates for various tenors. That is data is readily available. Now, where the judgment is required is, we need to take the risk-free rate which closest matches with the time period for which we expect this option to be open. I'll just give a simple example. If you are told today, let's say Hindustan Lever is selling at 1,000 rupees. If somebody tells you, okay, you can buy Hindustan Lever at 1,000 rupees itself, in the next 6 months, it has a certain value. They tell you can buy it over the next 1 year for 1,000 rupees. It has a higher value. So we need to take this tenor for which the option is available and choose the risk-free rate applicable to that tenor from the data which is available from FIMDA source. So that is the next information which needs to go in. And whenever we do period end valuation, this is another thing which can change. This rate could change significantly from period because of market conditions, and also because the tenor will keep reducing. Balance tenor will keep reducing. So that is also a factor which we'll have. Now, this is the third element we saw. The fourth element which needs to be looked at is the time to expiry. Now, time to expiry, generally, the theory is the vesting period, which is the period over which your eligibility to get the granted options becomes fructified in your hands. So that is the vesting period. In other words, this is the period over which the company is expecting to get benefit out of you, for which they are actually giving you this compensation. So this is the way it's looked at. So the vesting period, and after the vesting period, what is the exercise period? That is the time period given post vesting, within which you have the option to take these shares or reject the shares. So this is the total period. Now, most cases taking this total period may be okay, but in sometimes what happens is you may actually expect that the shares may be exercised earlier than the full exercise period. For example, let's take an example. Say 2 years is the vesting period, and then 5-year vesting period, exercise period is given. So totally 7 years are there. But because of the values involved and because of the interest to the employees to encash, you expect it to be sold, let's say, by the 4th year itself by employees, or taken by the 4th year itself by employees. Then your total period, you may want to consider a lower period than 7 years. You may want to even consider 4 years. Now, here there is a guidance which is given. Yeah.
Balu, is it may or you should? I think you should.
You should, if you have reasons to believe that that is the thing. So that is where one judgment is required as to whether it should be the full 5 years or lesser period which should be taken. And there is a specific.
This is more complex than normal valuation, yeah, MBV.
Pardon, Anil?
This is more complex than the normal valuation.
Yeah, 100%. 100%.
Yeah.
100%.
Okay. Yeah, please continue, Bal.
Because
the judgments at these levels which are making it complex, the actual working can be very simple because you don't need to know mathematics. So let me put it. So this is what I always say. Our input is really on the judgments. It is not on the arithmetics or the mathematics behind it. So that is not there are ready tools available. And if it were actually mathematics was so important, this would be done by statisticians and mathematicians, not by registered valuers. So the judgment is the most important thing here. So what is the expectation there? And there is one guidance also in the standard, which says that if you are expecting it to be significantly lower, you should have strong reasons to support the time period being taken as less. Because the lower the time period you take, the lesser P&L impact it has. So let's understand the criticality. If I take 7 years, let's say if the P&L impact is going to be 1 crore of rupees, if I take 4 years as the vesting, exercise period, the impact could drop by maybe to 50, 60 lakhs. So there is a significant impact which can come because of this timeline which is there. So one of the key judgments is on the rationale for how you choose this total time to expiry.
But Balu, on the annual amortization of that cost, is it still that kind of substantial impact? See, I can understand 7 year is 1 crore, 4 year is 60 lakhs. But when you look at an annual amortization, because you do it on a straight lining basis, would it still be so material? It
will be significantly material because unlike the total, when we are calculating, we take the total time to expiry, which is vesting period plus the exercise period. But amortization is done over the vesting period. So whatever you determine, 1 crore or 60 lakhs is written off over 2 years of vesting period. So the exercise period has no relevance for the amortization to P&L.
So wouldn't exercise period normally be taken as like a kind of a reducing scale or upward moving scale in our assumptions? Would you actually take an assumption that people are likely to actually acquire it in the 4th year rather than in the 7th year? So most of the time the judgment would be in a scale, right? 25%, 50%, and then something like that.
Yeah, correct. So generally what is done is each tranche, for example, there could be a grant. Today I'm granting 1,000 shares. I would say that 25% of them will be vesting in 2 years, 25% in 3 years, like that. So for each tranche, we do the valuation also separately. So for each tranche, it is valued separately with complete separate assumptions on all these parameters. So that way it has to be done separately only. Yes.
Is there some statistical records available in the market, or when you go and Google that, what has been generally the employee mindset of trying to, exercise some data being available across companies?
No, this is one area where there is no this thing, and it is impacted by many other factors. See, for example, I'll give you a practical example. What I had seen, the company had issued ESOP to its mid-level employees.
Yeah.
And that time when they were issuing, the market price was in the 90-100 range, whereas the exercise price was 35. So already it was 2 times in the money. 2 times profit was readily sitting there. And it was a listed company. So here they had given a 10-year exercise period. Now we actually took a view and we said it will be exercised very early. So in fact, we said within 6 months of their vesting, it will get exercised because it's already significantly in the money and employees will see quick money. And these are all mid-level employees.
Correct.
So here the stand could be completely different. As opposed to, let's say, 2 other cases we'll see. One of the banks came out with a scheme that they will give 100 shares ESOP to all its employees. It's only 100 shares. Now, even a low-level employee, 100 shares, what is the profit he's going to make? So he might just sit on it, pure inertia. So he might use the full period of exercise. He may not bother to immediately do. The third is the other extreme. Let's look at senior management. And they are given large quantum of this thing. They are already earning substantial money. So cash in hand is not going to really drive them. They would probably wait till they are close to their,
potential value.
Or when their exercise period is going to get over, and then get the best benefit when they can immediately sell and realize. So the whole thing could vary depending on this thing. Of course, like I had earlier mentioned, one area where we could do a lot of this thing is pick topics like this for some research to be done by the institute. A lot of data is available with MCA data now. A lot of data is available. The question is to do some research and build our own database.
Coming back. At the initial time, we find out the value of the share. Then inputs include exercise price determination. Then life of the option. So from there, we need to continue further.
So actually 4 aspects, including the risk-free rate, 4 things we have covered.
Correct.
The 5th item we need to cover is the volatility. Volatility is probably the one where more this thing is required, right? Judgment is much more grayer. Volatility can be determined. If it is a listed company, you can find the volatility of the script by looking at the past data of the same script. That is the first option which is available. The second option which can be looked at is comparable companies. You can take their stock prices and build volatility. There are ready Excel templates which are available to compute volatility if you have the share price movement over the period. So you can look at build volatility data like that. That is the second option which are available. The third is look at indexes like we have the VIX index in for volatility index. You can look at those to get an idea of this thing. So that could be at the third one is more like where you are dealing with some SME kind of company. And these VIX index would also reflect the large number of companies which are there. So you could look at something like that to do it. But the best would be to try and get some comparables and look at their volatility. One other thing, the last one is the dividend. 6th aspect to see is dividend. Dividend can be taken based on 3 things. One is looking at the historical trend. If historical trend is not there, you can look at the industry trend in that industry as to what kind of payout ratios they have, etc. Or based on some futuristic model of what the company is expecting to do. If it is a new company, if it's an early company, etc., you can take that. On dividend, again, just to touch upon, many a times I find that it does not have a significant impact to the overall option value. So you can to round up on all these things where you are taking judgment, you can do some sensitivity. By doing the sensitivity, you can determine which of the factors where you are using judgment has significant implication and then go more deeper into it. For example, if you find dividend is not having a significant sensitivity, whether you take it at 0% or 2%, simple rationale is fine enough. It's not going to significantly alter your this thing. Whereas the time period, for example, if you half it, you can have a significant impact. You have to have much more rational and much more deeper study into it. So sensitivity is one way of sanity check in the whole thing which can be done.
Superb, Bala, superb.
I was just going through the lot 1 questions, MPV. They're like really good questions.
Excellent questions, actually.
Absolutely fantastic questions. Yeah.
Brilliant questions, actually. Balu, before I can get to those questions, some of them are very nice questions. On the option pricing models. So what are the popular option pricing models for stock options?
Okay. So, see, there are broadly multiple models which are available. The most used for ESOPs is Black-Scholes model. In that also, the Black-Scholes-Merton model is the right name if you want to, because my Black-Scholes-Merton model incorporates dividend also into it. The Black-Scholes model does not incorporate dividend. Black-Scholes-Merton model incorporates dividend into it. So the most often used is Black-Scholes model, primarily because it is easy to use it. You just have to, once you have finished these 6 parameters, it's a question of 5 minutes for you to get your valuation. So it's only the judgment which is going into these 6 parameters, which is going to take time. And after that, it's a simple exercise of finishing it. But sorry, one step, I just want to go back and finish one more thing. These are the 6 parameters. But the other thing which we need to consider is also important. It's the number of options, which I thought I will cover because there is a critical thing there also. Though I am actually offering today, say, for example, today I am offering to 100 employees totally 1 lakh shares as options. Now, my options given today is 1 lakh shares. So should I book the cost for 1 lakh shares options cost into 1 lakh share? Is that what I am supposed to book? Is a question which will be there. The regulation is very clear that you don't consider the number of options into your option pricing. You consider it only in your computation later in the cost which you are going to compute. There, of course, you can take certain percentage of actual achievement. So you might say that though I am giving 100 people 1 lakh shares today as options, not all of them will achieve the performance criteria of, say, for example, staying with me. There will be an attrition. So what is my attrition? My attrition expected is 5%. So based on that, I can adjust for 5% and do only 95,000 as a cost computation. This is something which is adjusted every period end. But because this is only just a computation, there is no change to the valuation as such per option value. But the number of options which will exercise, you can modify every year end. You can modify based on improved information you have. So this is what our standard recommends. And that is one topic I just wanted to give these things to give the completeness there. Coming back, so Black-Scholes is the most used model. The second model which is used is the binomial model. Binomial model is suited for options which will have differing movements. For example, in Black-Scholes, what is the basic assumption we are having? We are having an assumption that there is a volatility, which volatility is a fixed thing. Whereas in a binomial model, you can actually define 2 streams of movement, upward or downward, which could be at differing rates also over the period for the future. Now, largely binomial models, in my view, are more useful when you are dealing with, say, OCPS kind of instruments or optionally convertible instruments, which have multiple twists into it. For example, it will say at the end of 1 year, the company will have the right to redeem at a certain price. At the end of 2 years, the investor will have a right to convert at a certain price. Like that, it will have differing terms. Then the binomial model is more useful. In ESOP scenario, largely what happens is these kind of simpler mechanisms would be a better choice. But in some cases, some ESOPs may also be defined or designed in a way that it provides, if you have a 15% growth, this is what you will get. If you have a 5% growth, this is what you will get, etc. In such rare cases, binomial can be used because it's more complex to build.
But otherwise, as you mentioned, it's largely the Black-Scholes model, and those who are having a consistent dividend track record, etc., they follow the Black-Scholes model. A few questions, Balu, which have come from the participants. Some of them are exciting. A couple of questions, I'll be happy if you can do a one-word answer, because some of them will require a little detailed explanation. The first one is a simpler one, so I'd request you to give a one-word answer. ESOP valuation is purely for employee benefit for purpose, or several other factors are considered to arrive at valuation. And secondly, is valuation to be done on the date of allotment or when the option is exercised by the employee?
Two things. First is with regard to the ESOP valuation, it is for accounting at the time of grant. It is for employee benefit or salary determination at the time of exercise. So, second part of it, at the time of exercise, it's not a tested thing as to whether the exercise date and allotment date, if it is not significantly different, the practical way companies are going about it is to take one of those dates prices. Okay. But in the case of listed companies, because the share price is readily available, they take the date of allotment price.
Okay.
As the basis of determining perquisite value.
Okay. The second question is very interesting one, but little bit of taxation, but I guess you should be able to address it. A seller has received consideration from the company for surrender of rights prior to exercise of options in equity shares of unlisted company held for more than 36 months. These rights were given to the seller by the company under the ESOP scheme. On what value will the same be taxed as capital gains? Whether on consideration actually received or value of the unquoted equity share valued under 11UA.
See, this is an interesting thing. I don't think there is a tested case on this. Typically, this is for surrender of the rights before it has been exercised, right? But he has become vested, right? So there are two different views which are possible. One could take a view that surrender is essentially an exercise and a buyback. So it should be treated as perquisite, could be an argument which can come. The second is actually the exercise has not happened. So it is a sale of any other asset, not a equity share. And whatever surrender price which has come, that should be the criteria, provided it can be valued, that itself can be valued.
Okay.
It's a gray area where there will have to be.
I guess so. That's why the participants also have a query on that. Okay. So the other interesting query, I think you also briefly mentioned earlier. Can future convertible instruments be issued under ESOP? And if so, how can they be valued?
Can future convertible instruments? So basically at the end of it, when I exercise, I'm getting another OCPS or something, right? Instead of an equity share. Yeah, that can also be done theoretically. There is nothing which bars. And accounting valuation will also involve nested valuation of valuing that OCPS at that point of time, at each point of time. Again, at the time of grant and at the time of the exercise to determine the perquisite value. So instead of an equity, you will have to end up valuing the OCPS, which he will be getting as the perquisite value.
And under what circumstances the value of options and value of shares will be same or different?
No, see, this is where I think people get confused. Value of options and share is not the same. Value of share is the value of the underlying. The option value is the premium you are paying to get the opportunity to buy that underlying at a certain price, predetermined price to your benefit. So option value and share value, this is why I said, in the unlisted company, first you will have to value the share, then comes the value of option.
Okay. This is a question we have discussed, but since a couple of members have asked, I am repeating it so that we can give clarity. Is it required for a startup company, private, limited and unlisted, to do a valuation of share at the time of grant of ESOPs? And can the company itself value or needs to get valuation certificate from a registered valuer?
So yes, first thing is yes, it has to value. And second is my interpretation is it should be done by a registered valuer, at least at the time of grant or for a set of grants. Year end is maybe little more grayer because all this is for accounting estimates. So it all depends on how critical and important it is to the financial statement in a larger picture. If you really look at it, if for the whole company this is a small cost, then whether it is done by a valuer outside or not, estimates may be taken. But my interpretation is registered valuer should do it.
I think it's good to get it valued, particularly unlisted companies, startup companies and all, because subsequently for taxation also it would in any case be required. So as a concept, it's good to encourage. I think the problem is coming from the way Section 62 of the Companies Act is worded. So if you look at 62, it talks about issue to existing shareholders. It talks about ESOP, and then it goes to preferential allotment where valuation is required. So it gives an impression that valuation is only for preferential allotment, and rights, obviously, it is not required because you're issuing it to yourself. So there is a little bit of trisanku which you end up there, but I think it's good to get it valued. Now, the other question, which is also very interesting. Next two questions are superb questions, Balu. Some ESOPs schemes are drafted in a way there is no expiry date for the option exercise period, apart from stating that they will need to be exercised when the employee leaves or when there is a liquidity event. How would you compute the life of option in such case?
So this is again an area where judgment is required as to when you are expecting the liquidity event to happen or your estimate of attrition whereby you can take a period. So essentially this requires a judgment, and that should also be captured in the report very clearly.
Can there be two fair values of the same company? That is, one fair value to raise funds externally, let's say that 62 subsection 1 clause C, preferential allotment, and one fair value for ESOP purposes.
Okay, my view is yes.
Okay.
Right. Well, two things could be there. For a simple example, let's say the ESOP is generally a very, very minor non-controlling interest, which is always the case. Mostly, I mean, I'm generally talking about ESOP is always a minute non-controlling interest, whereas the preferential issue could be for a significant influence or for a larger block. So there could be a premium attached to it in that ground. Second is there could be certain participant-specific benefits which could be factored in determining the preferential issue pricing. So in my view, yes. Would it lead to disputes? Quite likely with income tax at some points of time. Okay, because at the grant level, there is no issue for taxation. But when it comes to, say, an exercise, in fact, this is something I was just talking to a client a few days back also. There is an exercise happening in May, June. There is a fresh raise happening in August. Now, what price they have taken for June exercise and the August price are different. So what could be the reason? This is exactly the thing which was coming about, that there could be block premiums which are there and then participant specific this thing. Now here, because both are for taxation purposes, there is a likelihood, there is a potential for dispute in future. which will have to be litigated. I mean, there are certain things which have not been settled well in law in terms of ESOP. It's good to get that settled at some point of time.
But both these events would require valuation, right?
Yes.
So would the law, this is just a discussion, would the law not go by the expert opinion of the valuer at that point in time with that scope? I mean, this is just based on learnings from all of your experts in only.
From a simple reading of the Income Tax Act, yes, it should be possible to do it. But it is always possible for the Income Tax Department to put A and B together and raise it as a dispute. It will have to be litigated, it will have to be justified and proved. Yeah, sure. But till that happens and some settled case law comes, it is difficult to put that.
Unless, of course, the intent is questioned. So I think ideally, anyway, yeah, you're right. I think there's no way out of this. Revenue would always try to maximize revenue. So I think that is his prerogative to do it. But unfortunately, there has to be some framework within which somebody should litigate. But anyway, I think that's for another day, discussion for another day. Yes, MB.
In terms of grant, can the company take valuation post facto, that is after the date of grant?
Theoretically, yes, because it is for accounting. And though it is taken post facto, the report is dated post facto, the valuation date should be the date of the grant.
Yeah.
Yes, it could be done. In many cases, it happens like that also.
But I would encourage the company to take it at the time of grant itself, because as board which is approving the grant, they should know the cost of it. So without knowing the cost, approving it doesn't sound good governance. So logically, you shouldn't take it. But legally, I think since these are largely done for accounting purpose, you could take it later. Okay. So the observation is, so 3 valuations are required: share valuation, option valuation at the time of grant, and merchant banker valuation at the time of exercise. Kindly confirm. It seems that ESOP is a bad idea for small startups.
The benefits significantly outweighs what I have seen from some of the large benefits which have flown to people. Yeah, it is a tough call that there are 3 valuations which are coming up. Generally, the share valuation and the ESOP valuation is done in one shot, probably by the same valuer at the same time. So that is one which is required. And the valuation of share at the time of exercise by a merchant banker is a statutory requirement under income tax. That is also to be done. I think these small things, costs of doing these are far well addressed by the benefits which come. And one point I wanted to touch upon, most companies are treating the ESOP accounting cost as a business expenditure for taxation. Now, here again, there is no straight rule in the Income Tax Act which allows this specifically. There have been disputes. Most of the disputes have been in favor of the assessee, but at various tribunal levels. Nothing has come at Supreme Court level or something as a finality. So this is another area which is a gray area which is there. But most companies are taking it as a tax deductible expenditure. In fact, right now we have cases going on where under the old AS they had accounted lower cost. Now because they have transitioned to Ind AS, they are claiming a higher cost by revising the returns.
But again, MBB, is this not and should not left to the accounting standards?
No, it is accounted by accounting standards.
That's what I'm saying.
But tax department goes by the fact that there is no outflow of resource happening to you now. The options may or not get exercised and they may lapse, get forfeited. So we will allow you at that time. So I have had cases where they have been disallowed, cases where they've been allowed as well. So I've gone through a mixed experience on this.
Just imagine if the country were to align these together the income
Benefits.
tax and the actual accounting principles, so much of resources and time would get saved, man.
Exactly.
And PV, you should do something about it.
Sure.
Right, back to our
Maybe we should bring this as one of the ICDS or do away with ICDS, whichever way.
This is again an interesting question, Balu. How do employees who go for ESOP before listing of company come to know whether the valuation is properly done, as they have to pay perquisite tax? There's a second and third follow-on question. Probably you can answer the first, then I'll come to the next.
Yeah. So basically, it is a HR call and the management call in terms of trying to get them incentivized with this. Most times when the ESOP is being given by this thing, companies don't have a ready plan for a exit or an IPO very clearly there when employees are getting it. So when the grant is made itself, the employee needs to be convinced that this grant is to his benefit and it is going to be of a certain magnitude which he is expecting, right? For him to be keen about it as a method of compensation, or for him to factor it into his compensation. So it starts right at the time of grant itself that there is a need to sell this idea and make them understand what kind of returns can be there. And then actualizing it as it happens over a period. There have been cases where companies have not been able to actualize it and they have compensated by some other means also to preserve that kind of relationship and retain employees. So that is also there. So it's a question of more about the HR communication as part of the compensation package than value or trying to.
And also comfort to the employees that unlisted one. The exercise valuation is done by a merchant banker. It's done by somebody independent. And as we discussed multiple times, if the grant is also done by a registered valuer, it brings all of that independence and the employee could feel comfortable. Now, are there any restrictions on immediate selling of shares allotted through ESOP upon listing of the shares?
ESOPs, once it is listed, I don't think there are any restrictions on their sale if it has been exercised earlier.
Okay. Are the shares of unlisted company given in ESOP to be shown separately in IT return as part of disclosure?
I don't think that's a specific requirement.
Yeah, because at least we're not showing so lots of okay. So, but good question actually. Now, for ease of operation, can company plan to have grant date and year-end date be same? It's
convenience, that's all.
Yeah.
Very difficult to actually make it happen. It's convenient.
Okay. Could you explain a little more on how to determine volatility of share price in case of ESOP valuation of an unlisted company?
So volatility, like I was saying, in a case of unlisted company, the first option of taking your own volatility is gone. So the next best is to take the volatility of shares of comparable companies. Now, comparable companies, as our valuation standard says, generally you go by the same industry, etc., but it does not restrict you only to that. It can be by comparable risk profiling in any manner. For example, companies with similar kind of risk profile, if you are able to build, even if they are from different industries, you can take that and build a comparable companies list. And for those comparable companies, you can arrive at the volatility and then maybe do a averaging or something like that to arrive at your volatility for this.
One last taxation question before I come back to a second lot of questions which have come on valuation. A difference in taxation in the hands of employees for ESOP versus restricted stock units, RSUs.
See, as far as ESOPs are concerned, the exercise price minus, the market price on the date of the exercise minus the exercise price, that is what is treated as perquisite in their hands. In the case of restricted stock units, I think these are stock units which are paid in cash, settled in cash. My memory goes right. That is what I think he's talking about. Anything which is settled in cash, the cash component which is paid will be treated as salary straight away. So there is no other separate valuation which would be required.
Okay. These are relatively shorter questions, Balu, and a lot of questions. So as you have been responding last few minutes, quick answers. There may be circumstances where almost end of every month, some employee exercises the option, then will valuation exercise be done every month?
So like I said earlier, if it is a very volatile script where the values can significantly change, it is better to get it valued every month or every day also, if that is the case. I don't know, but look at it like this. If it is a listed company, the listed price is what is taken. So sorry, the quoted price is what is taken. There is no need. Exactly. If it is unlisted, if it is highly volatile, you need to do more frequent valuation. Otherwise, department is generally accepting reasonable gap.
Okay. Whether registered valuer only authorized for ESOP valuation for accounting purpose, or other professional like CA can also do valuation for accounting purpose?
As of now, it's a gray area, like I mentioned earlier.
Okay.
My own interpretation is it should be a registered valuer because it comes under Companies Act.
For private limited companies, comparable companies not available for volatility, can we take index historical volatility rather than company volatility?
You can take the index, especially I think the India index or something is a very broad spectrum index with a large number of SME companies in it. So something like that you can take as this thing. Like I said, one of the things you can do is do a sensitivity. Based on that sensitivity, then you can also decide whether you need to do some further analysis and maybe find something more apt. It's something we can look at.
Okay. There is a request for repeating how to determine the risk-free rate and where is that information available?
Yeah. Okay. So risk-free rate, I think the website is fcil.org or something, where you get daily rates for various tenors, gilt-edge security rates, various tenors. What they are doing is they are converting it into a zero coupon yield curve. So they take all the quoted prices of gilt-edge securities and then convert it into tenor-wise. What is the tenor meaning? 3 months from now, 6 months from now, 1 year, 2 year, like that. For fixed tenors, they give the yield. What is the yield expectation on that? So once you have that table downloaded for the particular period which you are going to be taking on, the grant date, close to the grant date, then you determine the total time to expiry of the options. And let's say the total time to expiry of option is coming to be 7 years. You can look up the rate accordingly in that chart. Sometimes for certain periods, it's not there. For example, after 5 years, it could be only for 10 years. So then you can do an midpoint calculation for 7 years based on these two and arrive at the rate you can take.
Are there any connotations for a risk-free return in terms of a risk premium on the country as well?
Yeah, you use the country where you are dealing with. For example, for Indian companies, we would use Indian risk rate, which already factors that. If it is for a
considering that, I mean, this is highly technical, but considering that the country itself is in a risk zone, so risk-free return would come from government bonds, right? Typically, correct? But the entire country itself is, say, for example, debt-ridden. So then you may want to also, say, for example, if you're valuing ESOPs in a country like a Nigeria, Nigeria may still be better, but maybe something else, then you would want to go to a risk-free return of a better.
So, for example, if you take the case, till now I have been talking about the rate to use for India.
Correct.
Now, there are possibilities that some Indian companies will have their parent stocks given as ESOP. So it might be in US. So you can't use the same 8%, 7% and all that for that. You use the US risk-free rate because their growth rate, their volatility will also be different. So you will take that US risk-free rate. And if you are doing for some third country which is having this thing, accordingly, yes, you need to take what will locally apply for that company.
So is there any guidance note available on ESOP valuation? To my knowledge, we don't have. Sarika, probably you can confirm.
Yes, there is a guidance note on valuation. Guidance note on accounting is there, which itself is quite extensive.
Balu, to be honest, for a moment, my heart stopped, you know. Heart stopped, actually. So, in any case.
I thought we are not doing, I thought MBB, we are not doing something right in the council. If we don't know and Balu knew. Yeah, but I think Sarika, that's I think a great input. I think, you know, of all the valuations, I do believe that I think this could become a very interesting topic for us to write on.
Yeah, we should develop at least a technical guide, if not a guidance.
Correct.
Let's work on this.
One small bit of thought on that is the guidance note on accounting for ESOP itself is very extensive on that.
Yeah.
So that is what I was also actually referring to. It even covers how to.
My experience, Balu, say, when I interact with members and I talk on this topic, everybody is expecting much more guidance on how to identify the risk-free rate, how to arrive at the volatility, how to make judgments on the performance conditions. In the accounting standard or guidance note, we can write only so much English. We can't write so much. So people are expecting, and I would request your help also in drafting a technical guide. Sarika, let's take it up on priority because many people do expect that. It's a good input. We will do that. But Balu, also requesting, are there any books or useful tools you can recommend as a good reading in the interim?
Yeah, actually, there are ready tools available for valuation using Black-Scholes and this thing. I think even our own, I don't know whether it's there in ICAI website, but at least in the RVO LMS, the ready templates are there for the option valuation. Calculators are readily there. Different types of option valuation which are normally used, right? Of course, Monte Carlo is not normally very frequently used.
I think Sarika, I would encourage you to take all of those and put that in our DLH also.
Yes.
From wherever you can get them, and you know, create some platform for valuation tools material on the DLH might just make it easy for our members also.
Yes, we have initiated the process. It will be done in a month.
Perfect. And if you are able to buy some, and of course this is out of this topic, but if you're able to buy some libraries or some platforms, then I think we should try and do that also as an overall for our members. Could be interesting.
It's a good suggestion.
Yeah, sorry, Balu.
And there are a couple of presentations also which are on ESOP available on LMS again in RVO. Probably that could be a simple, and it exactly addresses what MPV also saying, that guidance on where the judgments are required and how to go about getting these data, etc. So that could be useful.
So Balu, there's a query from member. First half of the question is basic, but the remaining part of the question is pretty important. Where are performance conditions or any other condition mentioned in the ESOP scheme? That's the first question, which I think is a simpler one. The second part of the question is how to include or consider this in the ESOP valuation. We did explain it earlier, maybe little more explanation.
Yeah.
Similarly, where there are conditions on exit on shares by founders, which is what we see in the case of the superior right shares, which SEBI has issued a consultative paper and all. So where there are conditions attached for founders exist, how will this be included in the valuation activity? Should something on profitability study or simulation be used in this?
Yeah. Okay. So let me go step by step on that. First of all, where these conditions are there, it is in the description of the option and its exercise, which will be there. And that is where these are described. When it will get vested. So typically the scheme might say it will get vested in 2 years' time. or it will get vested if and when a certain profitability or certain performance measures for the company is achieved, etc. So this is the first question, simple answer, which is there. Then coming to the different types of performance criteria which could be there are, one is the length of service, which is considered as a requirement for vesting, may vary depending on certain performance. For example, if the profitability is achieved, certain profitability achieved, say 10 crores of profit is achieved in 2 years, then vesting will be in 3 years. If it is achieved only in 3 years, vesting will be only in the 4th year. So this could be a kind of a performance criteria which is put. There could be varying performance criteria. For example, it might say if you achieve 10 crores by 2nd year, options granted will be 200 options. If it is achieved only by 3rd year, it will be 150 options. So the number of options could also vary. And like I said earlier, the option price could vary. Like this, there are various performance options which are there. And many of these are beautifully explained. Again, to say in the guidance note, which is there on accounting, in the appendix, there is significant, each type of this thing, criteria and how it could vary is all very well explained. We could take use of that to gain knowledge on that. Coming to the second part where conditions are attached. Yeah. So conditions are attached to the promoter's shares, etc. It will have to be factored in the valuation of the share itself. How we are valuing the company and the shares. These things will have to be factored there in the evaluation.
Okay. So, Balu, there are a few more very interesting questions. We'll try to catch up as many as possible.
Yeah.
The member is mentioning that you were explaining 2 scenarios under which valuation is required at year end. However, topic was discussed only for scenario 1 and we moved to other topic. So he's requesting if you can tell us what that second scenario is.
Scenario 1 quickly is for ESOP, where there is a performance criteria which affects, say, the price, the exercise price itself varies. Then it has to be done every period end. The second scenario is all SARs. All SARs will have to be theoretically valued every year end, every period end, because the value of SAR can keep changing.
Yeah, because it's basically liability accounting there.
Yeah.
So what is the significance of Black-Scholes method of options valuation for disclosures in financial statements of unlisted and listed company?
So Black-Scholes model is mandatory under those who are following, those who are following Ind AS. It will not just be for disclosure, it will be for even accounting. You need to do an option valuation necessarily. Whereas for those who are not under Ind AS, who are under AS, though it is the recommended method, there is an option to take a simpler method of accounting. And the current guidance is that if you are using the simpler method of accounting, there is no disclosure separately to be made of the option values.
Yeah, which is the intrinsic value method.
Yeah, intrinsic.
The next question is, at what time registered valuer report will be required and what time merchant banker report will be required? As I understand, we require registered valuer report only at the time of year end of accounting purpose. But on what basis we frame the policy of ESOP?
ESOP policy framing is purely left to the management to decide. They could take advice from a valuer or any other professional they need to, depending on this thing. So on structuring, there is no mandatory requirement of use of a professional necessarily. But when it comes to the accounting, at that time, generally the valuation is required to be done by a registered valuer, whereas merchant banker valuation is required at the time of exercise.
Okay. For determining the third input, that is time to maturity, whether we take period between grant date and it's a question mark actually.
Yes. We take the period from the grant date to the expiry of the exercise period or the expiry of an early exercise period if we expect it to be exercised early. So that is what we need to take.
What is the time period used for calculating volatility? Also, does volatility means standard deviation?
See, volatility calculation is best done over a period of at least 4 or 5 years. So you have, the longer the data, the better it is always. That is the crux of it. So volatility measurement always best is to take the longer period possible.
Okay. So volatility, if we need to calculate based on last 3 years, considering expected term, then past period of 3 years, we need to consider in totality or as 1 year and 3 different standard deviations.
Sorry, come again?
Yeah. Volatility, if we need to calculate based on the last 3 years, considering the expected term, then the past 3 years, we need to consider it in totality or as 1 year and 3 different standard deviations.
No, it should be taken as a total period, and the calculation should be done for the longer period, and the future tenor and the past need not be necessarily the same. It need not be linked. If your time to expiry is 3 years, you need not do a volatility check for 3 years in the back. It can be a different period. The longer the data, the better always.
So Black-Scholes model is typically used for valuing European options. How would you modify this to value American options, which are typically what are granted by companies to arrive at fair value?
See, the standard Excel templates which you would get Black-Scholes model, which you can build yourself, are European models only, right? So you have 2-3 choices. You are anyway taking the time to expiry, which is where you are factoring the early exercise as one way of compensating for this. There are some tools available, even on the web. You can search and get some tools available, which gives you Black-Scholes adjusted for American option. That is exercise anytime during the exercise period. But these are not, these are proprietary tools. You are just downloading and using them. You don't know their ruggedness and your this thing. Whereas the Excel-based basic template which you are creating is based on the formula, and exactly it works, and it's supposed to work the way it is to work. So to that extent, these are something you will have to balance and take a choice between that.
This is an interesting question, Balu. Will the high or small number of options influence the option pricing? Because greater the number, greater the potential dilution in future, which influences the share price. And if share price is influenced, option price will be affected, being the derivative of the share.
Now, this is a very interesting question. Actually, yes, there is a need to consider that in case of options where there is a significant component of overall options which are being considered. Typically, the simplest method which is used when you are valuing the share to consider options is to go by the simplistic approach of taking what is known as the treasury approach, where you say, okay, my value is so much, I'm going to issue 100,000 options. So at 50 rupees exercise price, I will get 5 million. So I add 5 million and take the total equity to divide equity plus the option which will get converted into equity to divide to arrive at the per share value. This is the simplistic model. Now, this simplistic model obviously has its own negatives, that it is not considering the actual potential value of the options and how much will get exercised, etc. So I would refer everybody to read. There is an article in the latest Valuation Professionals, Insight 6. I think the article has been written very well.
Standard Board of Institute of Standard Consulting.
Yes. And the article is written well, I think, by Ramesh Ji. He's done a very good explanation of the different models which are applicable. Again, like I said, it is all based on the materiality. See, the first thing we should understand is the option valuation, other than the merchant banker valuation, is for accounting. Now, when we say accounting-based valuation, we are looking at it as an estimate for accounting. So, based on materiality and other factors, you will see how much of a fine-tuning you will do. So, in a simple engagement where it's not going to have too much of an impact, you might take the simple treasury approach, which is easy to do. Where it is complex, then you go in for complex methods.
Yeah, I agree. So, Balu, Anil, with your permission, just a couple of more questions.
Yeah. I think the last question on Series A, Series B, Series D is also interesting. I don't know if.
Yeah, just go ahead with that, Anil. Just go ahead with that.
No, I think there's a question which says that company issues various series of shares, Series A, Series B, and Series C. ESOP is used under Series D, which has different rights and obligations. Example, doesn't have voting rights. How do we consider these factors in 6 steps discussed in option valuation? So how do you consider all of this? Is there a change, or how do you do, or is that nested or whatever? Yeah.
See, first of all, assuming this is a complex scenario where you need to do, first and foremost, when you do the value of the total equity meaning A, B, C, D together, right? If you have arrived at the total shareholders value, you need to allocate them first of all to A, B, C, and D based on the backsolve model methods, which itself is a very complex method to do. So, in practice, these are used only when we are dealing with very highly complex set of instruments which are being issued. Frankly, Indian market has not been seeing many such cases. Of course, it's also evolving. Things will change. The future could be different. And the implications, if it is material, you need to do that. Once you do that, then you can do a valuation of this. So that part considers, the backsolve method considers in allocating to the various instruments which are there, based on the liquidity preference, the various other rights which are attached to it. So that is how I would say that this will have a.
Is there a GST element to this? There's one question around GST, so I'm not sure about that. I'm not an expert. Is ESOP subject to GST when ESOPs are cross-charged to subsidiary company, or should it be charged just at cost, excluding taxes? Is there a...
Frankly, that is out of my...
Right.
No idea. See, when it is to an employee from the company, absolutely no doubt, there is no GST. Whereas when it is being given subsidiary being charged, that's a great area. I am not sure. I should not even venture.
I think maybe we get that response from a GST expert and put it as a part of our answer. But
sure. I think it's a good one, but surely good to know.
Absolutely fantastic question.
Because many companies do give their holding company shares, so there is this possibility of GST.
Good. So, Anil, I think we have a reasonably more number of questions, but I think it's overall time. As we have done for the others, we'll develop a ATQ for this as well and publish it. And Balu, thanks a lot for drawing reference to that Professional Insight Series 6. It's a very good 9-page article of Ramesh, and I would encourage everybody to read that publication too. So thank you all, and thanks, Balu, and over to you.
Thank you.
No, so thank you so much, Balu. I think this was really interesting, and I think we've got lot 4, which means I think the interest of our viewers is likely to get deeper and deeper into understanding valuations more and more. So I think just as we, myself and MPV and Sarika thought that it might be interesting to get these technical subjects out and maybe go a little deeper and dig a little deeper. I think there are a lot of questions which are unanswered, and maybe we could even pick up those questions for next round of discussion again, MPV. But I think this is, as usual, goes on well. So thank you once again, Balu. Appreciate this, and a warm response from the members is also highly appreciated. I think back to Sarika for doing the formal discussion.
Good afternoon, sir, and thank you all of you for watching this session. And one interesting thing is that members are asking questions out of the explanations given. So this is something that they're focusing on the discussion. So this encourages us to do more and more technical sessions. And thank you so much, all the participants, Anil Bhandari sir, MTV sir, Balu sir for coming again and sharing his knowledge and wisdom, and Segal sir for supporting this whole endeavor. I would again like to thank all of you, and we will continue with the technical sessions now. General sessions we have taken, and now we will have technical sessions. And one more thing, we have all the recordings available on the same link.
Yeah, I think there were questions around this. Thank you.
Yes, the link where you are watching, the same link recording is available, and ATQs are available on our valuation standards page of ICAI website. You can go to www.icai.org. Under the announcement page, we have all the ATQs available, and this valuation professional insight publication is also available. So thank you for your interest. We'll come back next week. Thank you so much, all of you.
So I think IMPV, is this black salt so interesting? Do you want to run a session around that as well? Just maybe picking up 2 models.
The only thing we need to do it with a spreadsheet. We need to do.
Yeah, of course.
So the format will be a little different. Maybe we can do a 2-hour separate workshop rather than part of the Sunday series.
Perfect. Thank you. All right. So thank you, everybody. Thank you, Balu, once again.
Thank you, everyone.
Thank you.
Thank you.
Bye, all. Thank you.
Thank you, Rakeshi. Bye-bye.